Good morning, everyone, and thank you so much for joining us today. I am Leslie Wyatt with SoftPro. I am a Director of Compliance, and I appreciate everybody joining us again. Believe it or not, we are on episode 26 of our webinar Saved You a Seat series. Today, we are going to talk about the 411 on 1031s. We're going to talk 1031 exchange rules and the process. And we have two people we're going to introduce here in a second to kind of give you two perspectives, if you will, one from a SoftPro perspective and what the program can do, and one just 1031 rules and exchange process in general. So before we get to that, I just want to remind everyone that we do record this, and you will get an email later this week, a follow-up email with the recording link and any information that we have pertaining to this webinar. Also, we encourage and welcome questions. There is a question feature to the right of your screen. It might be on the left, depending on where you have it, but just go ahead and click in there, and we will try and get through as many questions as we can. And if by chance we don't get through to your question, we will indeed try and answer it offline or include it in the follow-up email so that you can get an answer, or at least put you in touch with somebody who can provide you an answer. So with that, I'm going to introduce our two speakers today. You are in very good hands. First off, we have Anna Barsky. She is Vice President at IPX1031 Exchanges, and we thank you so much, Anna, for joining us today.
Thank you for having me.
Great. And then to take you through the SoftPro portion and how to kind of go navigate 1031s in SoftPro, we have Lauren DeNoia, who is our training manager, and I'm sure most of you know her, have had interactions. She's wonderful. We appreciate your time, Lauren, for helping us out with this as well. So I'm actually just going to turn it over here. Yeah, thank you. We're just going to turn it over to Anna and let her do her stuff and learn a little bit, because this is not my area of expertise. So thank you so much, Anna, and it's all you.
Thanks, Leslie. Thank you very much, and thank you everyone for taking some time to learn a little bit more about 1031 exchanges this morning. Nothing like a little tax talk to really get your energy going first thing in the morning. As Leslie said, I'm Anna Barsky. I work for IPX 1031. We are the largest qualified intermediary in the country. We're owned by Fidelity National Financial, so we work with lots of title companies all across the country. What I want to do today is just give you a quick overview of what a 1031 exchange is, what are some of the basics, what are some of the benefits, and then I'll talk about the 1031 process a little bit. It's really just to give you some tools to have in case your customers ask about 1031s, and if they are placing a title order, have any title issue, and mention during that process, hey, I'm also doing a 1031 exchange, you can give them a little bit of guidance through that. So just starting all the way at the very beginning, 1031 is a very simple transaction. It is part of Section 1031 of the IRS code, and it basically allows real estate investors to defer paying taxes when they sell a piece of investment property, and all that they have to do is buy another piece of investment property in a specific time frame. So very simple. Let's say Leslie purchased an apartment building 3 years ago for $500,000. She's now selling that apartment building for $800,000. The government is, of course, going to tax her on the $300,000 profit that she made. In order to defer that tax payment, all that Leslie has to do is buy another apartment building or buy another piece of investment property. That's really all that a 1031 exchange is. It's a sale plus a purchase equals a tax deferral. So that's really just the definition of a 1031 exchange. The biggest benefit of participating in a 1031 is the tax benefit. So it's a tax strategy, and some call it the last tax loophole that's out there. And this slide outlines some of the taxes that are deferred through the 1031 exchange. So capital gains tax, which is either 15% or 20%, depreciation recapture tax, which is about 25%, the 3.8% healthcare tax, state taxes. So when you group all of these together, most CPAs will tell you that their clients that sell real estate that don't participate in 1031s pay anywhere from 28 to 35% in taxes on the profits from their sales. And the 1031 is the only solution out there to defer paying these taxes when you're selling investment real estate. This slide outlines some of the other reasons, kind of the non-tax reasons why investors participate in 1031 exchanges. So in my earlier example, because Leslie wasn't hit with that tax up front, she's now able to purchase a new property that's a lot higher in value than the property that she sold. So your purchasing power is really dramatically increased when you implement a 1031 exchange and allows you to purchase a bigger, better property. A lot of the clients that I've been working with throughout the years maybe started with a $800,000 portfolio, but over the 10, 12 years that we've been working together have built their way into a $3 million portfolio. And they're able to do that rather quickly because they aren't hit with the tax every single time they sell a piece of property. So the purchasing power is another huge benefit of a 1031 exchange. The 1031 is very flexible in the type of real estate that qualifies and the type of real estate you can sell and buy to complete the exchange. So generally speaking, all investment real estate qualifies. And it could be a residential property, so it could be an apartment building, it could be a 2-flat, it could be a single family home that's used for rental purposes, it could be a condominium that's used for rental purposes, it could be any type of commercial asset, it could be vacant land, it could be farmland. And the IRS is pretty flexible in that they allow you to sell any one of those assets that I just mentioned and then buy any one of those assets that I just mentioned to complete a 1031 exchange. So a lot of our clients use 1031s to diversify their real estate portfolio. So for example, sometimes we have a client that comes to us and says, hey, Anna, I have a couple small apartment buildings all around Chicago. You know, I'm not really getting the cash I want to see on those investments. So I want to sell some of the apartment buildings, maybe get out of residential, and then buy a commercial property to complete my exchange. So now I have some residential and some commercial property in my portfolio. Also, the same type of client sometimes comes to us and says, hey, I'm sick of managing these properties. You know, I have all these residential properties and I'm sick of tenants calling me in the middle of the night. And I just want to sell all the residential properties, but I know I'm going to have a huge tax hit. Well, they do a 1031 exchange, sell all the residential property, and then they buy a property to complete their exchange that they don't have to manage, like a Walgreens or a CVS, one of those single tenant triple net lease properties. So the 1031 kind of allows you to move into different types of real estate, depending on what you're looking for from a cash flow perspective, a management perspective, location. You could sell property anywhere in the US and then buy property anywhere else in the US to complete your exchange. So a lot of our clients do 1031s because they're simply relocating. You know, they're moving from Wisconsin to Florida and they have a investment property in Wisconsin that they don't want to have to worry about managing from Florida. So they sell their investment property in Wisconsin, do a 1031 exchange, get that great tax deferral, and then buy a new property in Florida. So it's a little bit easier to manage. Another reason why clients use 1031s is to consolidate their portfolio. So they have a lot of small properties all across the country. And again, to make it easier to manage, they consolidate that portfolio and just buy one big property to complete the exchange. Similarly, you could sell one big property and then buy a couple smaller properties to complete the 1031 and expand your real estate portfolio. So in those ways, the 1031 code is very flexible. All investment real estate can be exchanged for any other type of investment real estate in the United States. You could sell several properties and buy one property, or you can sell one property and buy several properties to complete the 1031. Another huge benefit of 1031 exchanges is the estate planning strategy that comes from 1031. So when we're talking about taxes, estate planning always is, you know, kind of comes into the mix. Those two things really do go together. So something that we always remind our clients about is that a 1031 is a tax deferral mechanism. So when you do a 1031 exchange, the tax isn't completely wiped out. It's deferred until you sell the new property that you purchased to complete the 1031. But there is a way to completely avoid the tax, and that happens when an investor passes away, as morbid as that sounds. But when an investor passes away, let's say that they've deferred millions of dollars of taxes through 1031 exchanges throughout their life. When they pass away and their kids inherit the property, all the taxes that they've been deferring through the 1031 gets completely wiped out, and they have a tax avoidance. Their kids that inherit the property have a tax avoidance at that point. And we like to call that swap till you drop. That's our cute little estate planning slogan. But that's another big reason why we see a lot of clients participate in a 1031 exchange, because they've done so many exchanges. They've already deferred so much in tax dollars. They can't really avoid to cash out at this point. And they think ahead and say, okay, well, I'm going to leave this portfolio of properties to my kids, and my kids will end up avoiding all these taxes that I've deferred throughout my life. So, those are some of the non-tax reasons why we see clients participate in 1031 tax deferred exchanges. What type of properties can be exchanged? So some of these I just talked about. Again, it's any type of investment real estate. So it could be any type of residential property as long as it's used for rental purposes. Sometimes vacations homes and second homes qualify. Commercial property always qualifies for 1031. Farmland, vacant land, mineral rights, air rights, oil and gas royalties are exchangeable. You can exchange an interest in a piece of property. So even if you don't own 100% of an asset, you could still qualify for a 1031. And even if you're not buying 100% of an asset, you could still choose to purchase an interest in a property as your replacement property. So a tenant common interest in real estate qualifies for 1031. A Delaware statutory trust interest qualifies for 1031 and is also seen as real property. So again, any type of investment real estate works under the section 1031 code. Okay. Some of the properties that do not qualify for 1031. So money, cash, any kind of cash equivalents, stocks, bonds, notes are not exchangeable. Primary residences don't qualify because that's a personal use property, not an investment property. However, if you have a client that wants to sell their investment property, buy another investment property to complete their 1031, they can eventually convert it into their primary residence. And we do see some folks going in that direction. Property held primarily for resale is not exchangeable. So that means customers that are flipping properties, developers, typically don't qualify for 1031 because the IRS considers those assets inventory as opposed to investment. So if it's a traditional buy, rehab, sell, or it's a traditional developer that buys a piece of land, puts a building on it, and then sells it off a couple of years later, that also doesn't qualify for 1031 treatment. 1031 is really for investors that hold property long term that are getting cash flow from that property. An interest in a partnership, membership interest of an LLC, shares of a corporation do not qualify for 1031 treatment either. Even if that entity owns real estate, the individual owners of that entity do not qualify for 1031. So just to give you an example, one of the most common questions that we get is, hey, Anna, I own a property in a partnership. I'm in a partnership with my mom and my brother. I want to do an exchange. My mother doesn't. She wants to pay her taxes. My brother wants to do an exchange, but we don't want to buy property together. What do we do? And in that current structure, in that partnership structure, the individuals can't really go their separate ways. And that's one of the common issues that we really help structure, and kind of when we dive in and serve in an advisory role is we provide options and structures to change up that ownership so the partners that want to do an exchange can move forward with it. But just generally speaking, if you're owning a partnership interest or shares of a corporation, just in that structure, it doesn't qualify for 1031 treatment. So I'll go over with you quickly some of the rules that clients have to follow in order to complete a successful exchange, in order to get that tax deferral. One, you have to buy property that's equal or greater in value to the property that's being sold. So if a taxpayer is selling property for $1 million, they have to buy one property or a couple properties that equal $1 million or more. And all of the proceeds from the sale have to be used to buy the new property. So both have to be accomplished in order to get the full tax deferral. Another rule is that you have to maintain taxpayer continuity, and that's really just a fancy way of saying that the taxpayer that sold the old property has to be the same taxpayer that's buying the new property. So if you have a partnership that's selling the relinquished property, that same partnership has to be the taxpayer on the replacement property. Sometimes we have clients that say, well, you know, I'm selling property in my individual name and I want to set up an LLC to buy the new property. Can I do that? And as long as that LLC is a single member LLC with the original seller as the sole member, and that LLC is treated as a disregarded entity for tax purposes, they can absolutely purchase the new property in that LLC. So something important to remember here is that it doesn't have to be the same title holder necessarily. It just has to be the same taxpayer throughout the exchange. The like-kind requirements I've talked about. So the rule is that the property you're buying has to be like-kind to the property that you're selling, but the like-kind requirements are actually very broad. So all investment real estate is like-kind and can be exchanged for any other type of investment real estate. There are some time periods that you want to be aware of, and both time periods start ticking the day the sale closes. So from the point of the sale, the taxpayer has 45 days to identify a potential replacement property. And from the closing of the sale, the taxpayer has 180 days to purchase one or more of the identified properties. The taxpayer can only buy what they've identified within that 45-day period. So the advice we always give clients is plan ahead as much as possible because these time periods go very, very quickly. Within the 45 days, you do have some wiggle room. So you can identify property, revoke an identification, identify something else. But once that 45th day hits, you are stuck with what you've identified, and those are the only properties that you can purchase to complete the exchange. The time periods are black and white. They include weekends and holidays. There's typically no extensions for the time periods. That's one of the common questions that we get is, you know, is there an extension? I'm having trouble finding property, especially in the crazy market we're in right now. And unfortunately, there really aren't any extensions. The only time there are is when there's a presidentially declared disaster, which does happen, you know, with the floods and the hurricanes and the storms that we've had over the last couple of years. We have seen some extensions happen through that. But generally speaking, those time periods are black and white, and there's really no great way of getting around them. So those are some of the basic rules that you have to follow in order to get the full benefit of the 1031 exchange. Another rule that you have to follow is you have to hire a 1031 company, which is, of course, what I do. And our main function in the transaction, I should say one of our main functions in the transaction, is that we hold the funds in between the sale of the old property and the purchase of the new property. The 1031 rule is that the taxpayer cannot have constructive receipt of their funds. So those of you that have been involved in 1031s in the past know, and especially if you're on the closing end and you're closing a transaction where the seller is doing a 1031 exchange, you know that the 1031 company has contacted you and said, please wire the funds here. So the seller cannot walk away with the proceeds from the sale. Those funds have to be wired directly from the closing table to the 1031 exchange account that we set up. And that's one of our main functions, is to safeguard those funds in between the sale of the old property and the purchase of the new property. We get calls every single day with clients saying, hey, I sold my property a week ago. I sold my property 2 days ago. I sold my property yesterday. I forgot to set up my 1031 exchange. Can I still do it? The answer is no, unfortunately. So the exchange does have to be set up prior to the closing of the sale, and the funds have to go directly from the closing table to the 1031 exchange account. And this is, I think, where I see us working with the title companies the most. On the sale end, we're going to be coordinating getting the funds from the closing of the sale into the 1031 account. And when the client is ready to buy their replacement property, we're going to be coordinating with the title company on getting those funds from the 1031 account to the closing of that replacement property. So there's a lot of wire instructions that go back and forth, a lot of confirming wire instructions. And like I said, that's really where I see us working with the title companies the most. We coordinate with the closers on the settlement statement. Different 1031 companies have different instructions on how they'd like the settlement statement to look. Just as an FYI, the IRS does not care how the settlement statement looks. There's nothing in the 1031 code that says the closing statement has to look a certain way. So when you get instructions from a 1031 company, that's really just what the 1031 company prefers. We like to keep it as easy as possible on everyone. So we don't ask to sign the closing statement. We don't ask to be listed as the seller. We simply ask that you show that funds are coming to IPX 1031 as opposed to going back to the seller. I know that some title companies prefer listing the 1031 company as the seller and having them sign off, and that's absolutely fine. So you have to work with whatever 1031 company the seller has hired to really figure out what those closing instructions, 1031 instructions are. Our second role in the transaction is that we draft all of the 1031 documents that the IRS requires. So we draft the exchange agreement, all the assignment forms that are required. As a courtesy, we also draft the notification forms. There's a rule that the buyer of the old property has to be notified that the seller is doing a 1031 exchange. And similarly, on the replacement end, the seller of the new property has to be notified that the buyer is completing their exchange. So as a courtesy, we provide a notification form to that end. So anything that has to do with kind of all the 1031 documents and forms, we provide that. We draft a complete set of 1031 documents. And we absolutely serve in an advisory role as well. So we help guide the title company, the attorney, sometimes the broker through the process. We spot any issues that we see with the transaction, any red flags, and we really help structure a lot of 1031 transactions. A lot of the exchanges that we do, I would say probably about 60% of the exchanges that we do are fairly vanilla in that there's a sale and then an identification and then a purchase. But about 40% of the exchanges that we do involve a complex issue. And I just want to highlight these for you in case you see them on your end to help raise the red flag to our clients. And say, hey, you may want to, go back and talk to Anna, your 1031 person, about this particular issue. So these are the four most common, I guess, 1031 pitfalls that we see. Related party exchanges. So there's very specific related party rules, especially if the client is buying their new property from a relative. So either parents, grandparents, or a related entity. Seller financing, if the client is providing seller financing to their buyer, that has to be structured in a very specific way in order for that financing to qualify for tax deferral. Partnership issues, I mentioned those earlier, probably the most common 1031 issue. Properties held in a partnership or some type of entity, and the partners or the owners of the entity do not wish to stay together for a 1031 exchange. Reverse and improvement exchanges. So a reverse exchange is when the client is in a situation that they have to close on their new property before they're able to sell their old property. And those transactions are a bit more complex because we have to come into the chain of title. Also, improvement exchanges, those are a similar structure where we have to come into the chain of title. And an improvement exchange is a situation where the client is either building the new property from the ground up or they're making substantial improvements to that property within the exchange period. So once in a while, those transactions aren't as popular, but they still absolutely happen. We have a whole division dedicated to reverse and improvement exchanges. So something to watch out for on your end. You may sometimes see that an LLC that is wholly owned by IPX or wholly owned by a 1031 company is actually the buyer of the replacement property. And if you see that, that should be a signal that there's either a reverse or improvement exchange happening. So those are kind of the common issues that we see where we, again, really dive in and serve in an advisory role. And that's really the part of my job that I love, is kind of the providing solutions to these problems and providing structures to some of these more complicated exchanges. We're a national company. I happen to sit in our Chicago office, but we have 13 regional offices all across the country. We have about 150 employees. Like I said, we're the largest 1031 company by far. We do $100,000 exchanges on residential condos, and we do $100 million exchanges on hotels and retail centers, and absolutely everything in between. So if any of your sellers or buyers have 1031 questions or need a consultation, or have one of these issues and need some structuring help, please reach out to me or your local 1031 person. I think that's all I have for everyone today, but I'm happy to answer any questions you may have.
I think one of the questions that came in you answered was whether or not it had to be set up ahead of time or not. So I think you were pretty thorough and covered that already. So I do have a question though. I mean, because most people don't understand 1031s obviously are really just transferring, your proceeds into another home to avoid capital gains. And are you seeing anything with the new potential capital gains changes? Do you think that'll have a big impact to the 1031 market?
Yeah, I mean, if capital gains go up, that will of course have a huge impact on our the 1031 market and our business, because that would of course encourage more and more investors to participate in 1031s as opposed to paying their taxes.
Yeah, it'll be interesting. We're kind of watching that. Someone had a question that says, can you continue doing a 1031 exchange after 1031 exchange? I'm guessing they mean reinvesting the same proceeds over and over on different transactions.
Yeah, absolutely. And that's kind of that swap till you drop method that I had mentioned earlier. That's what a lot of our clients do. They buy a piece of property, it appreciates in value, they sell it, they don't want to pay taxes on that profit. So they do a 1031 exchange and buy another property to complete their 1031. And then a couple years down the road, they sell that property that they purchased a couple years ago and they do another 1031 exchange. And they just keep exchanging. And if you're selling and buying, there's no reason not to do a 1031 exchange, right? You want to keep your money and keep reinvesting it into bigger, better property as opposed to paying tax.
Another question someone had here is, how does the 1031 company's fee base? Is it based on the purchase price, or do you guys have like set fees? I mean, I know you can only speak to your own company really, but just
Right.
kind of as an idea for people that might be considering using you guys.
Sure. So we charge a flat fee for a regular exchange. So if it's a situation where the sale is closing first and then the client is buying a new property, within the 180-day period, there's a flat fee that we charge for that, just depending on the size of the transaction. It could be anywhere from $1,000 to $1,500. The reverse and improvement exchanges are a bit more complicated, and I know I didn't get into the specifics of those too much, but because we're coming into the chain of title, that's one reason it's more complicated. There's more liability on our end for that reason. We have to coordinate with the lender quite a bit. There's a lot more documentation involved, et cetera, et cetera. So those transactions, the fees vary depending on the size and the complexity of the transaction. And for us, those start around $5,000, but again, can vary. They could go up to $7,000, $10,000, just depending on whether it's a lender involved, what the size of the transaction is.
Yeah, that makes sense. The ones you just mentioned obviously are a lot more time consuming and a lot more work. So somebody asked here if you could address the issue of who, meaning the seller or 1031 exchange company, should be receiving a 1099-S on a 1031 sale at closing.
Yeah, generally speaking, the 1099 should be issued the same way it would be if a 1031 exchange was not taking place. The reason for that is at the point of the sale, we have no idea whether the client will be able to buy a new property and complete their 1031, right? So it could potentially be a failed exchange. They might not buy a new property at all, and then it would just be reported on their tax return as a regular sale. Also, I didn't get into this too much, but it's possible to do a partial exchange. So in order to get the full benefit, you have to buy property equal or greater in value, so on and so forth. But some of our clients don't do that, or they take some money at the closing of the sale because they just want to have some cash, and then that cash ends up being taxable. Or they buy a property that's less in value. They sell for $1 million, buy for $900,000, and the $100,000 would be taxable. So I say that to say that in addition to it potentially being a failed exchange, we also wouldn't know upfront whether they could possibly be doing a partial exchange. So therefore, the 1099 is issued the same way it normally would be. If they don't complete an exchange, they would use that 1099 and report a sale on their tax return just like they normally would. If they do complete a successful 1031 exchange, they'll bring that 1099 to their tax advisor, and the tax advisor will use that along with an 8824 form, and that's the form that's used to report the 1031.
Okay, that makes sense. We get that question, I can't tell you, all the time. Most people are under the impression that it goes to the 1031 tax exchange company, but your point is a really good way to explain it, is that, the intent is to do a 1031 tax exchange, but there's a bunch of variables that might come into play, and they may not either, like you said, end up doing it, or they could potentially do a partial. So that's a really good way for us to explain it. We have
Right.
one last question, and I'll be honest, I'm not exactly sure what they're asking, but somebody asked what production software you use. So I'm guessing for like any 1031 forms that you guys provide, the title companies, they're wondering what production software you use.
It's a internal software that our internal team created like 20 years ago. It's called WebQI. I'm pretty sure we're the only ones that use it. And I can, that's honestly all I know about it. But if you want to, whoever asked the question, if you want to reach out to me, I can get some further information from you. But it's a system that was created just for us internally.
Okay, great. Well, that's all the questions I have right now. I really appreciate your time. This is great information. And I think if we have some more come in, I'll certainly ask you, of course. But I think for now, I might go ahead and turn it over to Lauren.
Okay, let me go ahead and share my screen. And if somebody could just acknowledge that they can see my screen.
I can see it.
Yep, excellent. Okay, so what I will be doing today is walking you through what a 1031 exchange setup might be like in SoftPro Select. Now, we can do 1031 exchanges in any of our softwares, whether it's SoftPro Select, or if you are on the standard or enterprise version. There is a process, and we have those process documents available to you out on our F1 help page. Also, in all of our versions, Select, Standard, and Enterprise, you have the ability to set up a 1031 exchange on a variety of statements. So whether you prefer to utilize a HUD-based statement or a closing disclosure form-based statement, we have those setup processes available to you. For today's presentation, I'm actually going to show you a 1031 exchange setup on a commercial-based transaction. And that commercial-based transaction is only available in our SoftPro Select version. The advantage to the commercial-based transaction, and I'm going to actually draw upon what Anna had said when she indicated that, you know, the government doesn't really care what your settlement statement looks like. It doesn't have to be a HUD. It's not overseen by the CFPB, so it doesn't have to be on a CDF. The advantage to using a commercial setup is that I can customize the setup to be exactly what either my buyer or seller wants it to be, or my 1031 exchange company. And we'll walk through that. So where I'm going to begin on this commercial order is in my order contact screen. So what are the first things we try to point out on a 1031 exchange, outside of who our buyer is and who our sellers are, is who is the qualified intermediary that is going to represent either the buyer or the seller, or sometimes they are both. Sometimes it's a 1031 exchange coming in and going out on the same transaction. Within the order contact screen, I can set up contacts for qualified intermediary. They are a contact type, and as you can see, they've got different codes. So here I've got my Q code and my Q2 code. So that's telling me that, okay, we've got two QIs, or qualified intermediaries, that are involved in this transaction, but what capacity is each one of these QIs going to fulfill in my transaction? If we look at our buyer contact, we can see that I've got my Bob Buyer LLC, and next to the buyer contact, I've got the Q. And what that is telling me is I'm associating the first Q contact, the Fidelity Transfer Group, to the buyer. And I actually did that within the order contact screen itself. I have a field on the right-hand side of the name area where I can say which qualified intermediary is representing or is tied to the buyer and or the seller. So for demonstration purposes, I've got the buyer associated with my first QI. And if I come into my seller, you'll see that that code is Q2, which is directing the relationship between the second qualified intermediary to be tied to the seller. So I've got money coming in from a QI and going out to a QI, and they are separate companies. I would build my document the way I normally would. I would put all my adjustments and my payoffs and any charges that I would have and send them to my my document. And when I say document, I would say either my CD lines or my HUD sections. In this instance, I'm going to be sending all my charges to a statement charges section. And like I said, this is our commercial screen set, and this is allowing me to customize the sections to identify the areas that either my lender or buyer, seller, or QI company want me to represent in a document. I have the ability of customizing these sections. So maybe if my QI company says, look, I want all your payoffs to get grouped together in a section, and I want that section to be called payoffs, well, I can come into my statement charges area, and I can call that section whatever I want. So let's say I've got payoff of lien. And that allows me to customize each section to meet the needs of that QI company if needed. Most importantly is, how are we going to pay out to the QI from the closing? In our seller proceeds and 1099 screen, we have the ability to divert the seller proceeds to a line. And what divert seller proceeds will allow us to do is to set up our document in advance and just move the seller proceeds over to a line, again, on our CD or on our HUD, or in this case, in a commercial settlement statement. By utilizing the divert seller proceeds line, if I set this up in the beginning and then I have to go back, and I'm always making changes to my document, I have to change my rent prorations, maybe the settlement date changes, I don't have to go back and try to recalculate what is the seller supposed to get. What I'm doing is I'm actually moving the calculator that creates the seller proceeds into a line on the document, and I don't need to do any of that math. The system's going to do that math for me. So in this instance, I'm going to divert my proceeds maybe to miscellaneous charges. Maybe I have a section called proceeds to 1099 company. Utilizing my hyperlinks, I can jump right over to that line, and I'll see that the seller proceeds are being diverted over to a specific line on the document. I can call that line whatever I want, proceeds to 1031, and I can make the payment payable to my qualified intermediary. If I scroll down, I can see that the balance due to seller is 0 because that calculator has been moved over to the seller debit section. I have a CD order that is opened as well. I could divert that to section H or to section N on a CD. And if I click over on a HUD-based order, I can send that to either the 1300 section of a HUD or the 500 section of page 1 of a HUD. I'm going to go back to my commercial. So I've aligned this transaction now to pay out my QI. Remember that I have 2 QIs in this instance. I also want to receive funds from a QI. My order transaction screen allows me to see all the transactions that I have going on my document and what my register is going to look like. I can see that I'm paying out all my seller funds to a QI. My seller is not receiving any funds, but it looks like my buyer has to bring me funds. Well, I have the ability to change that and say, no, I am not getting money from my buyer. I'm actually getting money from the buyer's QI. It updates the system for me. So now when I do my receipting and dispersing, everything that is actually going to happen, money in from one QI, money out to another QI, is represented accurately in my system. To go back to the 1099 conversation that we just had, if I go back to my seller proceeds in 1099, notice that the name on the 1099 still says my seller. One of the options that we have within our sales proceeds in 1099 screen is the property services received checkbox. When I check off this checkbox, I'm telling my 1099 document to mark off that this transaction for the seller, either all or part of it, is part of a 1031 exchange. So let's go ahead and look at that document. I'm going to go into my documents. I'm going to pull up my 1099 for my seller. And when I preview my document, I'm going to see that that property services received checkbox has been, or box has been marked off. So I am able to submit a 1099 to the seller. I am able to upload a 1099 to the IRS. We could use the IRS Fire site, but when we upload it, it is going to be flagged that this is part of a 1031 exchange. So the system is going to capture all the information needed. Notice I didn't have to change my seller's name. The QI is not showing up on this 1099. It is drawing directly from the seller. There's also documents that might have to be populated. So I'm going to go back to my order, and I'm going to show you our statement header. Because I have associated a QI to my buyer and a separate one to my seller, notice that the header of my document, my settlement statement, is going to populate with that QI information. If I go to the footer and the signatures, now I have options where I can manually create a signature line that says my QI is tied to my buyer and or my seller, or I can include qualified intermediary signatures and buyer or seller signatures. So I'm going to pull that document and show you what that looks like as well. I'm going to go back to my documents, and we're going to pull a commercial settlement statement. So my master settlement statement is going to pull together all the buyer and seller information, and it will populate the header and footer the way I have designated on those screens. So if I need my qualified intermediary to populate on that document, I can have that. And if I don't need it, I can take it off. I can customize it. Like we spoke about in the beginning when we were talking about customizing the document, see how I utilize the sections to structure this document to be exactly what my QI company was requiring. And I'm going to go back to my signatures. I didn't print my signatures. Let me refresh and check that off. Let's say this is a final, signatures on final. Put up my signatures, and then here's my signature section at the back. Maybe I want my QI to sign along with my buyer and seller. If I don't, I would just uncheck that box and not have that QI sign off on the document. Again, what's nice about this type of transaction in SoftPro Select is that it is extremely customizable. So that's basically how we set a QI up. It's very simple. It's only a few additional steps from what you would normally do for a CD or a HUD. Does anybody have any questions with regard to either this commercial settlement statement or QI setup within SoftPro Select?
Lauren, we don't actually have any questions. You were pretty thorough.
Well, just as a reminder, like I said, we've got our job aids out on our F1 help for both for standard, enterprise, and select on how to set up a 1031 exchange in our software, either for the buyer and or the seller. And if at any point you ever have any questions, just feel free to call our support line.
Great. Thank you so much to both Anna and Lauren. We really appreciate it. I think a lot of people have a lot of misconceptions or just unknowns with 1031s, and they're pretty straightforward, you know, just kind of taking money you've earned and reinvesting it to avoid, you know, a big tax hit. So if anyone has any follow-up questions or would like any further information, you can certainly reach out to us. We're happy to help. As I mentioned earlier, we will send a follow-up email with a recording of this, and any questions we didn't get to or that come in, we'll include them there as well. And with that, I think we are going to say goodbye for the day, and I hope everybody has a great day and a great weekend. And we really appreciate you guys joining us. Thanks so much.
Thank you.